Hello, everyone. Welcome to GreenSky episode 12. This is the second episode that you're with Jeff Brunet, managing partner at GreenSky Ventures. We're very excited to have Jeff talk a bit about exits. Jeff has founded 5 companies and exited them to big names such as Apple, Google, HP, and private equity. And what I want to make sure that we get out of this episode is just go diving deeper into Jeff's experience with exits from the companies that he founded, how he approached them, how did they come about. And this is definitely something that entrepreneurs think about and talk about all the time. And they don't know how to approach it when it's definitely the first time. So, Jeff, we can maybe start with like a very quick intro to yourself, and then we can dive into the topic of exits.
Sure. Yeah, thanks, Moen. Jeff Brunet, Moen mentioned, spent most of my career founding, growing, and selling tech companies. After my first couple of successful exits, I've also been an active investor in a lot of tech companies and an active board member. And through either operating those companies or investing in companies, I've had managed to have some decent luck and some good success in exiting those businesses.
So what I guess maybe the first question is that how did that first exit happen? You mentioned a bit about it in the previous episode, but I'm curious to know how it came about.
Um, so I think there's two philosophies. One is build a great company and don't worry about anything else. Someone will pick it up if you build a great business. The other one is you need to spend time thinking about and engineering your company to be acquired. Over the years, with my experience, I sit kind of in the middle of that. And like we talked about in the last episode, my views have changed based on the experiences that I've had over time. The first exit that we had was, it wasn't a massive financial win. It was enough at our age that we were happy, and it was nice to see it. Looking back, it could have been much larger. But at the time, I think none of us, you can't tell the future, and we saw an opportunity. We did see some competition looming in terms of the large telcos coming in. And I think that combination, the potential competition coming in, who were the same people supplying the connections we were reselling, was definitely an enabler to saying, hey, now is the time to sell. There were a couple of considerations. I think one is, in my mind anyway, is what's next. So if we sell this business that we've spent so much time and money and tears on building, what's next? What am I going to do next? And that you can't help but ask that question, I think. So that comes into the decision. And in this case, we had 4 partners in the business who needed to make that decision together. And that was difficult as well. People were at different levels of comfort financially, different life stages. And so having everyone come to terms and agree, was my kind of first lesson in trying to build a consensus. We didn't have venture money in the first business. We built it organically and with some loans. So really it was just us who were making the decisions. So it maybe wasn't the best example of how to decide because it was early. We were very young and it was kind of an opportune time, and it was a non-venture backed business. As I started to build other companies and we got to the stage of selling, it was often, there was some kind of catalyst very, very often throughout all the sales I've been involved in. Sometimes that catalyst was you need to do a financing. You're going to go raise some more money. When you do that, you're going to suffer a certain amount of dilution. Everybody knows that. And as a founder, you're saying, okay, I'm okay with that dilution because the money coming in is going to allow me to grow the company to be worth a lot more. So you're choosing between that. And oftentimes when you do that, if you have close business partners and they know that you're raising money, that can lead to discussions about M&A. On the buy side, they know, hey, this company's about to get quite a bit more expensive. If we want early access to this, now is the time to buy before they take in a large financing round. So it can lead you have these catalysts. Running out of money can be one where you don't have a choice. You either go broke or you have to sell. Raising money is another one. Of patience, kind of founder patience. Is this, when you started the business you loved, is it still what you love to do all day, every day? And if not, that can start to drive towards looking at some kind of liquidity for the business as well. I think, back to what makes you think about an exit. Like, I do believe you need to spend some time structuring your business, and I've learned through the pain of not doing so, to be acquirable. I don't think you should change the way you do business to make yourself acquirable, but there are some things that you can do to organize the business, things you can do to have a clean cap table, things you can do around IP protection and filing, things you can do around employee and confidentiality agreements and NDAs, and just what seems like standard course as you start to get involved with more businesses on the buy side. A lot of startups are not organized, and I was one of them in the early days, where we just didn't have a lot of this documentation, and we ended up closing our deal, but it was really painful. It was very expensive on the legal side because we weren't as prepared as we should be, and we learned from that. And so as I went on to found companies, we would have a framework in place, and we would do things like file IP, knowing that it was very unlikely we would never assert that IP ourselves. We're a small startup with limited funding, but we did those things because in an acquisition, it drives the value of the company. In a large company acquiring, you absolutely can assert that IP portfolio. And so it's worth money. So, my view is somewhere in the middle. I don't think you should found a company with the idea of, I'm going to found it and build exactly like this because I want to sell it. But I think there's a lot of practical things you can do along the way to make the acquisition process a lot smoother, and B, to actually drive acquisition discussions.
That's very useful suggestions. I think you're essentially saying have proper corporate governance so that you're acquirable, because that bigger organization that is going to acquire you, they want to make sure that you nicely integrate, there are no red flags, there are no baggages, and essentially they can make use of this acquisition, and there is a defined ROI for them.
Yeah, for the technical people watching the podcast, my background is more deep on the technology side. It's like managing source code. It doesn't matter how big a company you are. If you're a small 3-4 person company and your source code is garbage and it's not documented and it looks terrible, it's going to be worth less money, and it's going to be hard to manage, and it's going to be hard to turn over to a new team. The same thing applies for everything else in your business. So you can kind of take that same methodology and just apply it to a broader set. In the same way, if your contracts are not clean and they're full of, vetoes on change of control or who knows what, you need to be thinking of those things. Think in the back of your mind as you're growing your business. Doesn't mean you're completely focused on M&A, but they're just practical things that help make your business more likely to sell, and then make that sales process much smoother.
Jeff, do you think there is a right time for exit? Like, do you think, first of all, were all of your companies, when you exited them, was it at the same stage? Let's say you raised a Series B and the exit happened, or no, that's not the case. And then, just like...
Yeah. It's a good question. I suppose the right time, there's a right time is different for different people. So after my first business, every other company I've had has been venture funded. And so there's a right time where the entrepreneurs, the founders want to sell. That doesn't always line up with when the investors want to sell. And that doesn't always line up with when the employees want to sell. So my experience has been at very different stages. The first company sold without venture. The second company, we actually had multiple signed term sheets to raise money. We had gone down early acquisition talks with a US company about 18 months after we founded the business. So pretty early into the business, we had a pretty serious acquisition offer. We couldn't come to terms on what the right sale price is. So we went out and said, thank you, great discussion. We're going to go and build this business. We're going to go raise some money and build a business, and we'll come back and talk to you and be partners in the interim. And so we did that. We went out and we actually got a consortium, some great VCs, put some term sheets in. We signed the term sheets. We then communicated back to the acquirer saying, we're done. We're down the path of raising money. And they then came back. We didn't know behind the scenes, but they kind of bet a lot of their operating future on this acquisition. And so they upped their offer significantly. And so now we were in this position. We have signed term sheets. We have an acquisition offer that all of us, the founders and staff, wanted to take. And so it's kind of digressing into a bit of a story, but what happened was we talked to our first investor who we knew quite well and said, hey, here's what happened. And he said, guys, amazing. Congratulations. Awesome job. We talked to the second investor and he said, guys, we have a term sheet. You're not selling. Like, we're not going to let it happen. We've signed a term sheet with you guys. And we were like, what?
And the money was not wired yet.
Money was not wired. No, this is just a term sheet. And,
Nice.
it was a non-binding term sheet with no break fee. But as people react differently to this type of news. So we went from this real high of, we sold the company, high-fiving the first investor who had given us the term sheet. The second investor, when we ended the call, he was saying, the next call will be from my lawyer. We're suing you guys. We're like, we're like, it's just so painful. And eventually the acquiring company, to make it go away, they paid them for their time on diligence, which I think is fine. And they were happy enough. And the people who did this, it's strange, have become friends over the years, and it's just business. And I actually ended up backing some of their companies later on in my career. But it's one of those things you never know. Like we really thought we were going down the path of raising venture money. We were certain of it, signing those term sheets. We did not expect the acquirer to come back. They did, and it eventually led to this deal. Other businesses, my last business that I sold, Wisdom, was an artificial intelligence company focused on training and optimization of AI models. That was a more mature business. We'd raised a fair amount of venture money, and it was you had to build a consensus to sell. And we were lucky enough and maybe experienced enough to know we didn't take money from people that we were not aligned with. So the venture funds that were in our business were all aligned on what success looks like. So to kind of go down another path for a second, I see a lot of deals that get done where sometimes the founders are either not being honest with themselves, or they're kind of hiding what they would really take on an M&A deal. And it just, as I'm sure you've seen, it just leads to lots of trouble down the road. So some of it was, in the early days was luck. A lot of it was, again, watching businesses that I'd invested in or spent time with have this problem. So we worked hard to avoid that and make sure we were very in sync on what success was and what a good exit would look like for all of our investors at different stages as they came in. And there were times where we didn't sign deals with investors because we were not on the same page, and there were no hard feelings. I think they appreciated that we were honest, and vice versa. There wasn't one formula. Going back to your original question on when is the right time to sell. I think it's hard to know if you're only thinking about yourself and you don't have other shareholders to deal with. It's a much easier question to answer. You look at the financial outcome for you, and you think about, do you love doing this, and what's next, and you make your decision. When you're in a larger venture-backed company, there are a lot of variables to take into consideration. And you know, my view as an operator, not necessarily as a venture capitalist, but as an operator, if you have a chance to sell the business where you and your stakeholders are going to have a decent return, do it. Don't wait. Don't, you know, I've heard so many stories where founders are going to make millions of dollars, change their life completely, deliver good returns for their investors, and they get talked into continuing to grow. They get talked into be patient. We can double this in another year. They may be right, and that might happen sometimes, but it doesn't happen every time. And so my view, you know, back to when is the right time, if you have a good offer that's paying everyone well, you should take it. And that goes back to the question you asked in the other podcast is being a repeat entrepreneur. The reason I had that attitude and kind of still maintain that as a founder is because you can do this again and again and again. If you're saying this is my one shot at a business and I'm never going to do another one and I hate it and I want to get rid of it and I know for sure I'm never going to do it again, you know, maybe your mind, you'll think differently. With me over the past, I was thinking, we have got a good offer, it pays us and our investors well, take it because I know I'm going to do another one. So that, you know, timing is different for everybody. I don't look at ideas as there are tons of ideas out there. And I think there'll be tons of ideas to come. Like, I don't think there is some special idea that is just so precious that you should keep it forever and not sell it. Maybe I'm wrong. That's my view. And so when the opportunity comes along to sell, it's primarily a financial decision. And that is what are the returns getting for investors? What are the staff getting, both in returns from the deal, but also where are they going? What's it going to be like on the other side? What are the opportunities for them for growth? You know, all those things are considered. I think the larger you get, the harder it is to build that consensus. I haven't had a company that's close to going public, so I haven't gone down that path. If I did get there, again, I would rather sell than go public. That's, you know, just, and
it's just a different beast, and everything changes.
Everything changes, and there are some things that are potentially good for outside investors that aren't so good for founders. A lot of investors don't have the same lockup periods that founders would. So there's a lot of considerations, you know, and it doesn't just apply to going public, but other deals as well. I've been lucky enough in the past to have experienced investors who really saw eye to eye and took our opinions with a lot of weight. You know, investors who ask the founders when an offer comes in, what do you want to do? You know, it's nice to hear that question. I think that's when you know you've got a business partner that you know is probably going to last across multiple companies.
Did you ever do anything actively to be approached by a potential buyer? Is that a thing? Do you have to strategically, I don't know, let's say early days is your Figma, you want to essentially show what you have, you probably have conversations with Adobe and they like what you, like, is that something that you can initiate by just like talking to potential acquirers, but not from the perspective of, hey, come acquire me, but just like know what I'm into?
Yeah, it's a great question. I think it's similar to raising money. You know, even when you're not raising money, you should be out talking to investors, letting them know what you're doing, letting them know what your plans are for the next year, letting them know when you might be raising money. And the same thing applies on the M&A side. And I think, especially in the enterprise business, a lot of those discussions are with your customers or with suppliers to those customers. You may be, as a startup, you may be part of a point solution that sits and fits well in a larger enterprise suite. And so you will come to know those partners in the enterprise as you sell in to enterprises together and get to know each other. A lot of deals are done that way, where you may have a larger company who starts to see, why is this little company winning deals? Why do we keep hearing about these guys? And those are the things that often spark M&A. So I think that you can be intentional about it. The extreme is to go all the way to the other side and hire a banker in anticipation of selling the company. My experience is that's a difficult thing to do. If you don't have an offer to buy the company already, it's difficult to hire someone to go out and sell your company. It happens, but often the results are usually not a financial home run. It can happen occasionally, but generally what I've seen is the results are mediocre to poor when you go down that path. You can, if you have inbound interest already, that is, definitive interest from a buyer. I've had very good experience with bankers where they can come in and help you talk to other buyers, not shop the offer, but let players in the same industry know that this is going on and that now you may be running a formal process. So there's a lot of nuances, I think, to it, and it's hard to have a right answer on how to build your company and what the right time is to sell. But I think, again, I subscribe to kind of in the middle. I think you can't not think about the future of selling your business, because it will dictate how you act in some ways and how you structure things and how you may even sign agreements and how hard you may argue over terms in an agreement that can go all the way back to M&A.
And I guess one of the things that I'm curious to learn about is essentially the deal itself. Like how much, I guess, you can negotiate, how much you can engineer. What do you have to look for in terms of a red flag in a deal? Maybe the price of a deal is amazing, but they're just gonna keep you on for a long time, and that's not something you want. Just based on your experience, what are some of the things that you've seen?
Sure. Yeah, it's a tough question. So I've seen deals where it was communicated that the technology was very important for the acquirer. The price they paid was commensurate with that. And then shortly after the close of the acquisition, they threw all the technology in the garbage and kind of came back and said, "Surprise, this is an acqui-hire." So it's hard to know definitively how it's going to go on the other side until you go through it. In terms of how much can you influence the price of a deal? I mean, this is at the heart of every M&A deal is how much leverage do you have? You can look at selling your company based on industry metrics. Say, well, I'm doing 10 million of ARR, so you should buy me for 50 million because, the market we're living in is a 5x multiple ballpark. Those happen a lot. They're not the negotiations. I like the negotiations where you can really win. And I don't mean extracting an unfair price, but you can get a price that doesn't make sense to the market, but does make sense to the buyer when it's strategic. If you're working with a partner who really needs the technology, you have blocking IP or such a head start, it's going to take them a long time to build it. And they can sit down on paper and justify a huge multiple based on all that. I mean, that's every entrepreneur's dream, is to be in that position where it's not a discussion about multiples, it's a discussion about how much is this worth to your business. And I think that's where those are the deals you read about and kind of scratch your head and say, why did they pay that much money? And usually there's an answer. And I think if you get into the details, often the answer will make sense. It just you don't know those variables when you hear about the deal size. So those are the deals that you, as the seller, you have a lot of leverage and room to negotiate. Competition brings in higher prices. If you're working with someone, they're a close business partner, and you're doing 50% of your revenue through them, they are not going to they're not going to pay an out of market price in most cases. If you've built something strategic and you have a head start and your company is in the growth stage and you're showing great year-over-year growth, and now you have multiple bidders, that's, again, now you're back to kind of an entrepreneur's dream when you have multiple bidders in a deal. And then you have the other side of that, which is you're having trouble raising money, sales are a little slow, and that can drive M&A. And when that happens, you have very little leverage, about the sale price. If you're up against the wall for money, you're not going to be able to hide that either from a potential investor or a potential acquirer. Everything about your business is going to be known. So, it comes back to timing a little bit. And you hear some people say the right time to sell is when you don't need to. There's some truth in that. You don't want to be up against the wall when you have to sell your business. But sometimes the way things work is you don't have a choice. You're in that in between stage where you can't quite show enough progress to raise money, and you still have enough value in the business that you can architect an exit that takes care of everybody.
Got it. This is great, Jeff. Thank you for sharing your very valuable experience with entrepreneurs. And I think we talked about it a bit. Like, not a lot of people talk about the exit. Like, all we talk about is like fundraising, growth, sales, and then what happens to the exit? What happens to the end game? And I think just having gone through that multiple times, having experienced that with different parties and different buyers at different stages is just like an amazing experience that you shared with the viewers. And just like the one thing that has stuck with me is that there's no right time. Like, you can't really you can obviously proactively think about it, strategically approach different potential buyers, but like it like sometimes it just happens organically, sometimes it happens very early, sometimes it happens later. What you need to know is that you have to be patient. You have to be able to work with the stakeholders that are around you, especially when it's a venture-backed business, because then it's not just you or, let's say, your co-founders. There's also other stakeholders in addition to your employees, and that is essentially what you need to like take into consideration when an exit offer is coming to you. But yeah, this was great. Thank you for sharing all of this, and I guess in our next episode, I want to dive a bit deeper about your investment experience and the investment life.